part of the evolution of impact investing that we've seen is that evaluating impact can actually come as part of this due diligence process, which was not always the case in the past and is still not the case for every impact investor. But I've been seeing a lot more investors start to integrate impact as less of a measuring after it has happened and more of a proactive evaluating during due diligence and then measuring as well once the impact has been achieved. So when you're going through due diligence, you can look at evaluating impact based on these elements that we discussed also actually in one of the free webinars. I don't know if any or all of you were on that webinar, but when we were talking about impact, I shared this slide then as well. And so just coming back to this about, when you're thinking about impact, it's really up to you because impact can come in so many different forms. It's up to you what kind of impact you want to seek and what kind of impact you want to look for in a company. So knowing that from your end first is where you always want to start. So thinking about who do you want to impact and what kind of benefit are you hoping that those people or environmental factors would receive. So, who do you care about? Is it women and girls or poor families or farmers? And is it community or country specific? Is it industry specific? It's really up to you, but just self-assessing before going into due diligence is helpful to know what you're looking for. So let's say maybe you're interested in benefiting farmers. Well, how do you hope that those farmers might benefit? The most basic thing to look at with impact is income, right? So we would hope that if you're investing in a company that supports farmers or works with them, that as a result of that, those activities, the farmers would make more money. They would be better off, after engaging with that company. But maybe the companies you're looking at are deploying social services like healthcare, education. So you wouldn't have an income benefit, but you would have other benefits like, families who have access to good healthcare and educational outcomes. So it really depends on the area, the industry, or the type of services and activities that you're looking at. But then you want to think also, how will they impact these people? So I've worked with a lot of agri businesses that talk about impacting a relatively small number of people, but in a really life-changing way, because if you work in an intensive way with farmers, you can really change their ability to grow their business, to make an impact on their families by really increasing their income astronomically. Whereas in things like financial services, you might see these big numbers, like we're going to have thousands or even millions of customers, but the benefit to each one of those customers is pretty marginal. It's pretty small. It's not going to change their life, but it will give them some small benefits through, for example, using a mobile money service. So thinking about the scale of the impact is important as well for when you start to evaluate the impact projections and the numbers that companies will start throwing at you. So when you're going through due diligence, a lot of companies operating in Africa now have gotten used to talking about the impact that they have, some in more sophisticated ways than others, but a lot of them will be able to give you some metrics and projections about the impact that they expect to have on their customers, suppliers, or employees. So the most basic impact metric is how many people are you going to benefit? And who are those people? So is it that you are deploying some sort of product or service that is going to benefit your customers? Well, then how many customers do you expect? Is it that you are going to offer really good jobs to marginalized women, perhaps, who wouldn't be able to access those jobs otherwise? And how many employees do you expect to have? So that's kind of your top line number. Farmers would often come in as suppliers, so you would be sourcing from X number of smallholder farmers. So they'll probably give you a top line number. We're going to have 9,000 customers in the next 4 years. So I've given this example here on the right about a company that I worked with in Burundi. They were deploying loans to smallholder farmers to purchase the inputs to start growing sunflowers on their land, intercropped with other things that they were already growing. And they wanted to see if they could help these farmers to grow sunflowers, if they could start their own sort of sunflower oil processing business line within their manufacturing company. So the impact numbers that they threw out was that they were going to provide those loans to 9,000 smallholder farmers over a period of 4 years. So that's a lot of farmers. They were a pretty big company. So we thought maybe that was possible. But it's good when you're looking at that top line number of beneficiaries to really understand what makes sense for that business and for the market. And you can fit that in with the other things that you're assessing during the due diligence that Kenneth was talking about understanding the size of a market, the size of the business. And so when you start to see the impact projections, you want to compare those numbers to those other, business plan metrics and see if they match, see if they make sense within the overall story that the business is telling you. So then you want to know a little bit about the characteristics of the beneficiary. So smallholder farmer is a kind of ubiquitous term in Africa, for example, and you might want to interrogate a little bit what they mean by that. It's kind of like saying a low income beneficiary or bottom of the pyramid. What does that mean actually in terms of the income level of these beneficiaries? Sort of how disadvantaged might they be in accessing the market system already? It depends on the kind of impact that you want to have, but it's useful to really put a face to those beneficiaries, kind of understand who they are and if they align with your idea of the kind of people that you're hoping your funding would have an impact on. So understanding a little bit about, is it women and youth that they're working with? Maybe that's important to you. Where do they live? This is a really big one. A lot of companies I've seen say that we're benefiting rural customers. And you say, okay, well, what do you mean by rural? Because there's rural, there's like peri-urban, there's sort of just around the outskirts of an urban area. And then there's sort of rural, and then there's like really last mile out in the bush, very hard to access rural. And often you see companies say, we're going to benefit these communities that didn't have access to these services before. But they're really not able to profitably reach truly remote communities. And as they develop their business, you'll see them pulling back closer and closer and closer their distribution to a city because it costs so much the farther you go into rural areas to distribute products and services. That people will claim that they're going to do that they're going to reach these remote rural communities, but then they actually can't work it into a profitable business model. And so you start to see impact drift with things like that. So you can interrogate that a little bit if that's something that matters to you when you're doing your due diligence. Maybe it doesn't matter to you. Maybe a household benefiting is a household benefiting regardless of where they live. But if reaching remote rural communities is important to you, then interrogate that. So it's just good to sort of dive into these buzzwords that people use sometimes and make sure you really understand what they are able to do within the realities of their business. Sometimes the beneficiary is not a person, sometimes it's the environment. So then you can look at things like, are they working on climate mitigation or adaptation, resilience? There's all sorts of different things within the environmental side that you can look at as well. So what is the benefit going to be? This is where you get some standard metrics, like we're going to create 100 jobs. You might want to ask them, well, what kind of jobs? Is it a full-time equivalent job? Is it a quality job? How do they treat their employees? Just high level number of jobs might not mean a lot, but you see that in a lot of impact projections. It's just, oh, we're creating jobs, therefore we're having an impact. So that's something that you can interrogate if it matters to you. You'll see this funky word sometimes called net income benefit. So when you think about income as a very common benefit to customers, or obviously employees as well, or suppliers, all of them could have an income benefit. Net just means there is a cost associated sometimes with accessing a product or service. So the net is just the positive income benefit minus the cost that's incurred to take part in whatever this company is selling or operating. So sometimes companies will use that term, sometimes they'll just use income as a term. There's all sorts of different standardized metrics floating around out there that you can learn about as you start to specialize in different sector areas. With climate, it's tough. It's like CO2 emissions, forest acres, Resilience is such a huge gray area if you look at sort of adaptation to climate change and resilience around that, that you really need to work with some specialists who understand that to dive into something like that. And then there are specific outcomes to sectors like education and healthcare. So it's something that you can look at once, if you focus on a sector, you can look up some of these standardized metrics that are based on the sector, and we can share those with you as well, so you know what you're looking at. And then the way that they should be measuring impact, how much impact is from a baseline. So make sure that they have a baseline, which is sort of before making this investment, before doing these activities, before running this business, baseline is 0x whatever. Farmers were making $100 last year, and we expect with our products and services, they'll be making $300 next year. So, do they have a plan to measure that? So this company that I worked with doing sunflower oil in Burundi, their plan was that they were going to give out $800,000 in loans to 9,000 smallholder farmers over 4 years. So again, we looked at those numbers and said, that's probably really ambitious, but maybe they can do it. They said they were going to, disaggregate that. Of those 9,000, 3,300 would be women, and they expected them to end up producing sunflower seeds, and that would lead to an income benefit for them, minus the cost of the loans and the inputs, the seed, planting a sunflower and everything that goes along with that, and harvest and all of those costs. There would also be an extra nutrition benefit for the kids because they would eat the sunflower seeds in the morning, and it would keep them from getting hungry during the day at school. So that was a cool little added on impact that's very hard to measure, but is more of a qualitative story that seemed important. And then they expected that each farmer would make an extra $200 a year selling these sunflower seeds back to the company to create oil. So what happened in Burundi was that they missed every single one of those impact targets. They didn't meet one of them. And so that's something to remember. I think Anjali mentioned it last week, that the projections for startups are always wrong, and that includes the impact projections. They'll just, a lot of people just throw these wild numbers out there, and you can assess them, and you can tell them they're wrong or not, but that's actually not really what's most important when evaluating impact. What's most important is to understand whether the impact is related to the core business. So in Burundi, for example, finance, like giving loans, input loans, was not the core business. It was an agro-processing company. So they're a manufacturing company, essentially. They're not a financial institution. So that wasn't really core to their business. And smallholder farmers were not their core suppliers. They were used to having much larger commercial agribusinesses supply them. So those were, if as an angel investor, those would be red flags to me. If those were impact areas that I cared a lot about. This company I was working with in Burundi, we was with a grant fund, an innovation grant. So we were not investing. And this is sort of where the role of grants come in, is to test things like this that might be red flags or yellow flags to an investor, but that a grant maker can take that risk on. So we decided to take this risk because there were really large incentives for this scheme to work, and potentially large impact for the farmers. So from the company's perspective, agro-processing and fast-moving consumer goods were core to their business, and they were market leaders in that space in Burundi. So we saw them as a really capable business. So if they could make this work and integrate sunflower oil as a core business line for them, then it would have a huge impact and it would be sustainable. So we were willing to take that risk. It was a strong financial incentive for them as well, because they were breaking into this big market for sunflower oil. Cooking oil is a huge market, and they didn't have hardly any competition in their own market in Burundi for this. So we thought that that was a good bet. And then they also had an incentive to work with smallholder farmers because they could get access to their land, and land is relatively scarce in Burundi. And they needed that kind of access. They couldn't just like go and farm all these sunflower seeds on their own. They needed people to farm with them. So we saw these as really important incentives on the impact side, where we thought even if the projections are wrong, the businesses can make this work. So these are the kind of things that it's important to look at, is like, is the impact you care about really in line with the company and what they want to achieve on the commercial and financial side? And at the same time, what are the operational and opportunity costs related to achieving that impact. So, for example, working with smallholder farmers is very costly. It's expensive, to manage those relationships. And so we didn't know if it was clear whether this commercially focused business would sustainably, bear that cost over time of working with smallholder farmers. And that's what we were trying to figure out through this sort of grant funding test. And I actually left that business before I left that role before that project ended. So I don't know what happened, but you guys are happy to take a guess. I feel like maybe they made it, but because the business really had some strong incentives to make it work, but you never know. So this is the last thing I'll leave you with is just this transitioning idea about evaluating impact as a cost or a benefit to you as an investor. When you're looking at impact, the old view from a lot of people was that impact would be a cost, but you care about it, so you do it anyway. Root Capital is a business that an investment firm that finances smallholder farmers and agribusinesses in Africa, and they came out with this report a few years ago that was really interesting, and I can share it with all you, that looks at sort of evaluating for sustainability and ESG and impact during your due diligence can actually have financial benefits over the long run as well. You can use it to identify risks. You can generate new business with it, they found. You can really focus on the growth potential of specific businesses. So when they were looking, for example, at financing companies that would in turn finance smallholder farmers, they looked, for example, at the relationship between those companies and the farmers. And they say what we call social impact in the form of timely and ideally higher payments to producers, to the farmers, is simply good supplier relations to the agricultural business to which we lend. And looking at environmental impact in the form of training for sustainable agricultural practice often translates to long-term productivity and supply security. So they saw that, impact, if it is core to the business and it makes sense to what the business is doing, can actually improve your financial returns over time and reduce your risk. And the same thing, especially in agriculture, when looking at environmental aspects, if you look at sustainable productivity over time, then that can increase both your positive environmental impacts and your financial returns over time. So something to think about as you're wondering, how much emphasis should you put on ESG and impact? ESG is environmental and social governance, by the way, during your due diligence. And there's a financial case for it as well.